rate futures are priced just like bond prices are. And by that I mean they move inversely with interest rates. If interest rates go up, then the value of both futures contracts and bond prices both fall. So if you're looking at an interest rate futures contract, the price of it, and let's say you see it's at $98.75, but then a week later you looked at that same futures contract, the price of it, and you saw that the futures price was now trading at $96.84, then you can look at these two, the change in this futures price from one week to the next, and infer what's happened with interest rates themselves. Here, the price of the Treasury has fallen, and that means that interest rates have risen, just by this relationship here. To see why that's the case, that is, to understand it more fundamentally, why interest rates rising lead to a fall in both interest rate futures and bond prices, and vice versa. Suppose that you are going to buy this bond, and the bond costs $100, and that interest rates in the market right now are 5%. If interest rates in the market were at 5%, then that means at the time of issue for this bond, it's probably going to get a coupon of 5% as well, assuming away any corporate default risk. So every year on an annual basis, you get $5 as a result of buying this bond. And for the life of this bond, you're going to continue to get $5 each year because that's the coupon payment. Plus, at the end of the life of this bond, you'll get the money back and a final payment. The company is committed to you, the company that issued this bond, to pay back at this coupon rate of $5 based on this $100 of this face value of the bond. So it's a fixed rate bond. But suppose later that sometime a year or so later, interest rates moved up, so that now any bond that gets issued, a new bond, has to offer 7%, because interest rates are just higher in the market today. If that's the case, then any new bond that gets sold in the market then has to offer a coupon of $7. And that's what that firm has to commit to for the life of this bond. But suppose that you wanted to sell this bond that you bought a year ago. You bought it for $100, it yields you 5%, but you want to sell it in a market that now that other bonds are trading at 7%. Other people bought their bonds at this time for $100, and for those $100 they're getting 7%. In this case, it's unlikely that you can sell your 5%, your $5 per year bond for the same price that you paid, $100. And the reason is that anybody else can go out and buy a bond, spend $100, and right now get a interest rate that earns 7% per year, $7. So there's no way that you can sell this without cutting down the price. So let's suppose that you did that you dropped the price. The company on this bond still pays $5 per year, but that you dropped the price to say $70. So you sold this bond to someone else, secondary market, for $70. The bond still pays $5 per year, but then any buyer effectively now gets, because they bought at the cheaper price, a yield of 7%. And at that point, they're kind of indifferent between buying this old bond that effectively gets them the same thing as buying a new bond that also gives them a 7% yield on their money. But if you see what happened when interest rates rose from 5% to 7%, this bond that you bought originally for $100, the value of that bond dropped. In this case, it dropped to $70. You could only sell it for $70 because interest rates had risen so much that there were just so much of a better option out there where any new buyer of a new bond could get 7% rather than the original 5 that you locked yourself into. So this is why in the real world you see this relationship between interest rates and bond prices, as well as the prices of interest rate contracts, interest rate futures. As interest rates go up, these two things fall in value, but vice versa, As interest rates fall, these two things rise in value. It's an inverse relationship, and this is why.